Today we're talking to you about the effects of interest rates and inflation on the real estate market, and you're very well positioned to educate us on this subject.
Look, inflation and interest rates that are totally related also affect long-term debt, meaning in the States it's the US 10-year Treasury, here's the 10-year gilt. Real estate prices are real estate valuations are directly correlated with the 10-year bond, the government bond. So when the government bonds were close to zero, cap rates were in the between 3 to 4% here in England. In America, also high 3s to mid 4s. Now on commercial properties, now those cap rates are incrementally higher. So it means that multiples change. To put it in perspective, the cap rate is where you take the income of the property and you divide by the interest rate. So a 5% cap rate is a 20 multiple, right? So say if the risk-free rate, not really interest rate, the risk-free rate was at, say, 2 or 3, cap rates could be around 5, because people want 200, 250 basis points over the risk-free rate. So when pre-COVID, very easily, a $5 million property could be worth at the 4% cap rate. At the 4% cap rate, you divide 5 million by 0.04, the property is worth 125 million. At the $5 million, at the 5% cap rate, that's the same as a 20 multiple, because you're putting 5 million over 0.05, is worth 100 million. When the risk-free rate goes up, very easily to today at 3.68. If you are 250 basis points above that, you're at 6.2. Here my example is 6.5. At 6.5, you're at 76 million in value. If you were pretty conservative 4 years ago and you borrowed at 50%, your leverage would be 62.5 million, right? If 4 years ago, at the valuation 125 million, the value of your equity was also 62.5. At 76 million, at the 6.5 cap, the value of your property is 76 million. Unfortunately, you still got the same cost of debt. So the value of your equity is 13.5 million. So when you look at it, when your loan comes up, the new lender or the current lender says, I'm still going to lend you at 50%. At 50%, you can only borrow 38 million because the value of property is 76. At 38 million, if your debt is already 62.5, because previously you were 62.5, you're going to come out of pocket for 24.5 million. You're short out of pocket. You either have to sell the property and only end up with 13.5. This is a typical situation of a distressed sale. Unless the guy has laying around 24.5 million hidden somewhere that you can put into this pocket.
Or that his rent is going to go up by 100%.
Or, yeah, and a lot of these guys, the rents are not going to go up. And say a lot of my properties, the rent is fixed for 10, 15 years, or it goes up 2% a year because I have a contract to that effect. So it becomes a problem.